My comment section thinks I'm a dividend idiot, and here's the uncomfortable part for some of you. They're right. Every time I post about dividends, here they come. Mikey, you're paying taxes for no reason. Just buy growth and sell 4% a year. Dividends are just your own money handed back to you. Here's the thing, they're not wrong, but they're not right either, because our dividend smart isn't a yes or no question. It's a whose money are we talking about question. Let me explain. Real quick, I'm not a financial advisor, and this is not financial advice. I'm a guy who's been investing for 30 years, showing you how I think about money. You're a grown adult, do your own research. Here's my bias up front. I like getting paid to hold. There's something about waking up, checking my account, and seeing money hit. Money I didn't have to sell anything to get. That's the dream I'm building towards. Eventually living off my dividends where my portfolio pays my bills and I never touch the shares. Now let me be transparent, because that's the whole point of this channel. I'm nowhere near there. Right now, my dividends cover a fraction of what I need. My goal is 10 grand a month. And I'm honest about the gap. I'm not living off dividends yet because I'm pouring cash into other things. My house isn't paid off, not even close. I've got a real estate portfolio with real costs. I'm building Glazed, a physical product brand, and physical products eat cash fast. Every dollar going into inventory is a dollar not buying SCHD. That's a choice I'm making with my eyes open. So when I talk about dividends, I'm not talking from a beach, I'm talking from the middle of the climb. Okay, here's the idea the whole video hangs on. Your money should go depends on your investing DNA. No matter which way the market moves, for me, dividends are the counterweight to the risk I take everywhere else. But a 25-year-old with a stable job and 40 years of runaway, their DNA is completely different, which is exactly why my haters are about to be right. Comment number 1, Mikey, you're getting taxed on those dividends for nothing. They're right for a lot of people. Here's the deal in plain English. When a dividend hits your account in a regular brokerage account, you can owe tax on it that year, even if you reinvest every penny and never spend a dollar. You didn't sell anything. You didn't cash out, but the tax bill shows up anyway. For a young investor grinding to build wealth, that's a drag on the engine. Every year you're handing a slice of taxes instead of letting it compound. Over 30 years, that's real money. But before you go selling everything, there's a flip side. So what do the smart commenters say? Do it in a tax advantage account, an IRA, a Roth. And you know what? They're right. If you're gonna hold stuff that throws off a lot of taxable cash, a tax sheltered account is often the smarter home for it. I'm not going to pretend otherwise. But here's what they miss. That's an argument about which account you put dividends in. It is not an argument that dividends are dumb. It's a location problem, not a strategy problem. Right stuff, wrong shelf. Hold that thought. Comment number 2, just buy growth and sell 4% a year. Same income, less tax. That one's smarter and the one I respect most. The math, instead of holding stuff that pays you, you hold pure growth. Let it compound untouched, and when you need income, you sell a little, say 4%, and live off that. Because you control when you sell. You control when you get taxed. And historically, growth has crushed dividend payers over long stretches. For a young person with decades ahead, this is probably the better play. I'll say it plainly. So why don't I just do that? 2 reasons. 1, selling shares to eat only works when the market's cooperating. In a good year, sure, trim 4%, easy. But picture 2022, your portfolio down 30%, and now you have to sell shares at the bottom just to pay your mortgage. You're eating your seed corn in the middle of a famine. A dividend, on the other hand, usually keeps paying whether the market's green or red. Companies with a dividend fight like hell to protect it. 2, go back to my DNA. I run businesses. The last thing I want in a downturn when my business income might all also be soft is to be forced to sell investments just to survive. Getting paid without selling isn't only about tax efficiency for me. It's about not being forced into a bad move at the worst possible time. For the 25-year-old, sell the 4%. For me, I want the checks. So if the haters are right for young investors and I'm right for me, who's actually right? Both of us. And that's not a cop-out. That's the whole system. Here's how I actually organize it. 3 buckets, each with one job. Bucket 1, growth. Your wealth builder. Pure engine, no compromise. For my growth, I hold SCHG. That's my no apologies growth exposure. If you're young, this bucket is most of your money and there's no debate. Bucket 2, dividend growth. This pays you now and it raises the payment over time. My anchor here is SCHD. It's not a giant yield today, but it's quality companies that have raised their payouts year after year. The slow, boring compounder. This is the counterweight I keep talking about. Bucket 3, high income. Bigger monthly cash flow, less upside. This is where those juicy double-digit dividends live. Funds like QQQI and JEPQ. This bucket pays the most and grows the least. And notice, this is exactly the bucket my tax haters are talking about. High income, taxed as you go. Which is why, if you hold this bucket, you think hard about what account it lives in. Now picture building a house. The ETFs in these buckets are your foundation and your frame. Individual stocks, for me, that's names like Maine, MPX, Delta. Those are the renovations. Nice to have, but you build the structure first. You can build real wealth on the 3 buckets alone and never touch a single individual stock. The magic isn't picking the perfect bucket, it's setting the mix based on your DNA. Young and stable, heavy bucket 1. Carrying business risk and craving cash flow like me, more weight in 2 and 3. Same 3 buckets, different recipe. That's the strategy that survives every "you're doing it wrong" comment because it was never a one-size-fits-all. Now, it's one thing to talk about these buckets, it's another to actually manage them. So let me show you a move I just made in my own account that puts this whole thing into practice. Because this is investing in public, here it is in real time. I just sold about 10 grand of JEPI. Nothing wrong with JEPI. I just want that money working somewhere with a little more punch in my high income bucket. So right now I'm deciding between JEPQ or QQQI. Both play in the same NASDAQ sandbox. QQQI, a higher distribution, but a big chunk of that is something called return of capital. Basically, the fund handing you some of your own money back. Sounds weird, and the tax man treats it differently too. JEPQ pays a bit less, but the income's more straightforward. I haven't pulled the trigger yet, I'm sitting on it. When I decide, you'll see it here, the win or the mistake out loud. That's the deal. In full honesty, I'm holding too many tickers right now. DEVO, MPT, O, SECO, and more. At some point, I want to consolidate, simplify, clean it up. I'm in no rush, but I'd rather show you the messy real version than a fake clean one. So here's where I land. Are dividends smart? Wrong question. The right question is, what does your DNA need this money to do? If you're young with a steady income and decades of runway, the growth crowd is probably right. Lean into the engine. But if you're like me, building risk everywhere, wanting checks that show up whether the market's up or down, dividends earn their seat. The people in my comments aren't wrong. They're just answering for their DNA and assuming it's yours. Don't build a stranger's portfolio. Build the one that lets you sleep at night. That's the only strategy that actually works, the one you'll actually stick with. If you made it this far, you're my kind of person. I broke my entire 3-bucket portfolio down, the exact funds, the exact split in the video on your screen right now. Go watch that one next. I'll see you over there.